Hi, my name's Paul, and in this video, I'm going to be covering Goeasy's 2023 first quarter financial results and conference call. Then I'll briefly be going over how I'm valuing the stock. And really quickly, for anyone who might have clicked on this video not knowing anything about Goeasy, Goeasy is a Canadian company that trades on the Toronto Stock Exchange under the ticker symbol GSY. Goeasy's business model involves two main segments. The Easy Financial segment, which offers different types of loans and ancillary products to people who have less than ideal credit scores, and the Easy Home segment, which offers lease-to-own furniture, appliances, and electronics. These segments of the business operate out of physical retail branches, as well as through their own online platforms, and through partnerships with merchants at the point of sale, both online and in person. Finally, Goeasy's business model is designed to provide flexible and easy-to-understand lending services to customers who would otherwise be taken advantage of by predatory payday lenders. Now, getting into this quarter's results, first we have the gross consumer loans receivable. And this is just the total amount of money that's owed by the borrowing customers to Goeasy. This quarter, the numbers came in just shy of $3 billion, which was another huge jump up from $2.1 billion in Q1 of last year. So this was really strong growth. But the new federal lending regulations that I covered in depth in this video haven't come into play yet, so a lot of this growth was to be expected. Also, before I move on, some investors might be tempted to just look at this number and compare it to the market capitalization, which would indicate about a 70% discount to the current share value. But this would be a pretty big mistake since these gross loans receivable don't take everything into account. For instance, there are always going to be a portion of loans that are not going to be collectible, called charge-offs. In addition to that, Goeasy is currently in the phase of taking on debt themselves in order to build up their loan portfolio. Plus, like every other company out there, Goeasy also has expenses that must be paid. So, while it is really good to see that the amount owed to Goeasy is growing substantially, we still need to be aware that this growth is only one part of the story. Noting that, this does show that there is growing demand for Goeasy's loan products, which was further illustrated in the conference call where we learned that there was a 31% increase in applications for credit this quarter. Here, we also learned that net customer growth was up 26%, as well as a host of other really strong quarterly highlights, as you can see on this slide from the Q1 presentation. Quickly jumping back to the gross loans receivable, here we can also see the time to maturity for the bulk of these loans, and it looks like the majority of them are set to mature 5 or more years out, with only 2% of the loans set to come due within the next year. Unfortunately, we don't get to see what the average rates of interest are relative to each grouping, so we won't be able to get an accurate depiction of the future interest inflows from the current gross loans receivable. But if I had to give my best guess, I'd assume that the majority of the longer-term loans will be at lower rates, since they're more likely to be for things like vehicles and homes. So while it is nice to see that the company has several years of interest set to come in from their loans, it might turn out to be the case that interest rates on loans with further out maturity dates aren't quite as high as the rest of the portfolio. Now, this isn't something to necessarily be concerned about, but it is something to be aware of. And while we're still on this page, here you can see the difference in size of the loans receivable relative to each segment of the business. And while it looks like Easy Home is still growing, it is getting rapidly outpaced by the Easy Financial segment in a dramatic way. Now, this growth in consumer loans did of course reflect positively on the revenues, which had organic growth in both the Easy Financial and the Easy Home segments, for a combined 23.8%. And again, here you can really get an idea of how much better the Easy Financial side of the business is, with its growth rates coming in at 28.7% and 23.3% from lending and commissions, respectively. On the other hand, the Easy Home segment had paltry revenue growth of 2.1%, coming mostly from commissions and the growing interest owed by customers. But Easy Home's leasing revenues have actually declined since Q1 of 2022. That said, the Easy Financial segment makes up a much larger portion of Goeasy's total business, and some growth on the Easy Home side is better than nothing. Now let's take a look at the operating expenses, which for Goeasy includes bad debts, depreciation and amortization, and other operating expenses. Looking at the bad debts first, this segment includes two things. First is charge-offs, which again are just loans that are unlikely to ever be collected, and second is the change in provisions for future loan losses. The charge-offs, as you can see here, were relatively flat as a percentage of the portfolio, which is good news. But because there were a lot more loans written in the quarter, there was a sizable increase in the cash value of these charge-offs. Again though, this was in line with expectations. Noting that this growth of Goeasy's loan portfolio also increased the amount of cash that needed to be put aside for future expected loan losses. But the percentage of money that has to be put aside has gone down relative to the total value of the loans that were written by about 140 basis points or 0.14%. And this is just because the company has been writing more loans that are considered to be lower risk. And I'll be touching on this a little bit more later on in the video. Next we have the other operating expenses, which increased by 13.6% this quarter. And this mostly just had to do with the costs associated with loan portfolio growth, which would include things like hiring more staff to write loans, though there was also a one-time contract exit fee that also showed up, and this will be adjusted out once we get into the net income portion of the video. Last up, the depreciation and amortization only increased by 3.8%, and this mostly just had to do with the fact that there were more physical locations open than in Q1 of last year. So basically, there's just more property to depreciate now. If we tally all of that up, the growth of the revenue outpaced the growth of the operating expenses. And factoring all these expenses in, we can see that the operating income for Q1 hit $102 million, up about 27.6% over Q1 of 2022. Needless to say, the operating income growth turned out to be pretty good, but there are still non-operating expenses that have to be taken into account before we can actually get to the net income. For Goeasy, these variables include other income and financing costs. Starting with the other income, this involved a gain of about $2 million due to the fair value change of the company's investments. Now, this doesn't mean that the company gained $2 million worth of cash. Instead, it shows that the held value of Goeasy's investments have increased by $2 million. But it's important to be aware that the company did not sell these holdings. So this is essentially just an unrealized gain, which will be factored out of the adjusted net income since this isn't really indicative of a regular cash inflow or outflow that can be expected to happen in a recurring fashion. As for the financing costs, these were up a whopping 45.8% over Q1 of 2022, coming in at $34.2 million, which isn't great to see. But a lot of this had to do with Goeasy borrowing more money in order to grow their business, as well as having to pay higher interest rates on the debt due to the federal interest rate hikes over the past year. Thankfully, due to the use of interest rate swaps, the vast majority of Goeasy's debts are locked in at fixed rates that average about 5.4%. Now, combining all of these factors and adding in the income taxes that had to be paid, Goeasy was left with $51.4 million of net income in the quarter, which was up 97% over Q1 of 2023. But this isn't entirely accurate because we still have to adjust out all the anomalies that can't be expected to regularly recur. And this is one nice thing about Goeasy's reports. The company includes a lot of extra data that helps investors get a better idea of the company's performance. In this case, they've added a section where they've already made the appropriate adjustments in order to show the organic earnings growth. And here we can see that Q1 of 2022's numbers appeared artificially lower due to a fair value loss on its held securities, which again only tracks the change in price of the securities that are held and is not indicative of shares that have been sold. After the adjustments have been made, we can see that the more accurate net income growth was about 15.6%. That is a world of difference from the GAAP net income growth of 97%. But even still, 15.6% growth is by no means something that should be complained about. Now, for most businesses, I would prefer to look at the free cash flow. But for companies in certain industries, the standard free cash flow calculations aren't applicable. And for businesses in those industries, free cash flow can be a less useful indicator than the net income. As you may or may not be aware, the business of lending money is often one of these industries. And this is because lenders usually put out a lot of money up front in order to gain several years of interest and principal return in the future. To give you a quick example, if a lender loaned out $100,000 at a 10% APR, a free cash flow model would show $100,000 going out the door and only $11,000 coming back in the first year. This looks like a loss of $89,000. But that's not the truth of the situation. There's still a lot of future value in the loan that is expected to be returned. So a lot of adjustments would have to be made in order to control for this, and even then, it won't be perfect. Nonetheless, Goeasy still makes the attempt with what they have. But instead of measuring cash inflows from operations to get a depiction of how much money came in relative to the costs, Goeasy instead subtracts the operating expenditures from the net growth in consumer loans receivable during the quarter, which already includes the capital expenditures. So in the end, we aren't exactly getting to see the free cash flows, since the net growth in consumer loans still have to play out, and it could end up being the case that there are tons of charge-offs on these loans, whereas the free cash flows for most other businesses points to the actual cash that has gone through the business to be used for allocation. This is why for a company like Goeasy, I prefer to look at the net income. All of that having been said, we still have to finish up with the profits on a per share basis. And to do this, we just have to try and factor in any buybacks or issuance that was done by the company. Going over to the normal course issuer bid segment, here it is stated that the company did not repurchase any shares within the quarter, but the company did issue some additional shares which will negatively affect the diluted earnings per share figure. Fortunately, this impact was relatively small, so Goeasy was still able to grow their adjusted earnings per share by roughly 14%, achieving $3.10 in the quarter. Taking a look at the company's liquidity, it's in this section that we can see how much immediate money the company can come up with if required. And it looks like Goeasy has access to $1.07 billion if we include the agreement that came subsequent to the quarter's end, granting access to $150 million. But most of this available capital is pre-approved debt. Meanwhile, about $72 million is interest-free cash that is currently sitting on the company's balance sheet. So it looks like there's more than just a little bit of wiggle room for the company to continue growing out their business. And given the current demand, it looks like Goeasy is going to be able to capitalize on the demand very nicely. And this slide here should help us to see where some of that growth could come from. Based on this chart, it would appear as though Quebec, which is the second most populated province in Canada, is pretty heavily untapped, since it makes up only 12.6% of loans, despite it making up about 23% of Canada's population. So I'd imagine that in the coming years, we'll start to see the management really drive towards expanding further into the Quebec market. As for net locations, this quarter saw 8 net store closures. Now, this doesn't sound great, but it isn't exactly bad news, since 8 of these closed locations were Easy Home, which is the less lucrative business segment. Plus, the 2 Easy Financial locations that were closed were replaced with newer locations. On top of that, Goeasy has been doing more and more of its business online and through merchants at the point of sale, which of course has much higher margins than the more costly brick and mortar stores. Now it's time for the really big news. Despite the apparent regulatory setback that will be reducing the maximum allowable interest rates on loans down to 35% in Canada, Goeasy actually increased its 3-year future outlook on certain metrics. The high-end projections for gross loans receivable have increased for both 2024 and 2025. Then 2025's net charge-offs are expected to be lower. Meanwhile, total revenue and operating margins are projected to be in line with what was previously projected. Also, the projected yield on consumer loans has barely budged. This was phenomenal news. However, these are just projections, and performance does still need to happen. That said, on the conference call and in the presentation slides, we did get some justification for this very strong outlook. First, the regulation isn't expected to make its way into legislation until 2024, which means that the company can continue writing loans above 35% until this legislature gets passed, and those loans will continue to be legal until they've been repaid. Personally, I expected this legislature to come into play within the next quarter or two, and this might have just been my own personal ignorance regarding the process of the federal budget report. So for me, this was a very positive surprise. Next, we learned that Goeasy has already done a pretty good job of getting in front of the regulations, with the weighted average interest rate of its consumers coming in at 30.2%. And that's the lowest that the average consumer interest rate has ever been for the company. This has been achieved through offering newer products, attracting customers with better credit scores, and improving the credit of its existing customers through a positive reinforcement model. And these strategies have allowed the company to rapidly increase its scale, which is expected to be beneficial to the company's sustainability under the new regulatory environment, which will likely disproportionately have negative impacts on lenders with less access to funding. And this should, in turn, decrease competition and win Goeasy market share. Now, whether things actually play out this way, we'll have to wait and see. But it does look like this will likely eliminate the possibility of additional future regulations, since it will benefit the more responsible lenders like Goeasy. Furthermore, Goeasy has constructed a plan to keep on some of its customers that are just outside of the 35% APR range. At first, this sounded a bit scary, but on the conference call, it was stated that the lending market is semi-elastic, meaning that there is some wiggle room to increase rates slightly without driving customers off to find loans elsewhere. So, the company's plan post-legislation is to increase rates by about 2% on all consumer loans that are currently below the 35% APR. This way, the company can still access a portion of the customers who would otherwise have to be denied loans, while also creating an additional cash inflow that should act as a buffer to protect against customers with higher likelihoods of being delinquent on their payments. Also on the conference call, it was mentioned that there was a lot of data that had to be analyzed in order to come to this decision. So the management believes with a high probability that this will be a successful compromise. As far as the new products go, these involve a greater focus on secured loans as opposed to the unsecured loans that have historically made up the largest portion of Goeasy's loan portfolio. Since Q1 of 2022, the percentage of loans that are secured by some form of collateral have increased from 33.7% to 40.5%. And on the conference call, it was announced that the goal of the management is to flip the percentage of Goeasy's secured and unsecured customer loans, with an end goal in mind of between 55 and 60% of customer loans being secured. Next, on the call, it was noted that the company will be able to achieve its goals by reducing its efficiency ratio and improving its operating margin. Now, this might sound contradictory, since it sounds like efficiency is going to go down, which would likely have the opposite of the intended effect on the operating margins. But very quickly, for anyone who might not know, the efficiency ratio looks at the operating expenses as a percentage of the total revenue. So a lower efficiency ratio means that it costs less to achieve the revenue. Thus, a lower efficiency ratio is actually a good thing that will lead to higher margins. So basically, the company is just saying that they'll be controlling and potentially even lowering expenses in order to achieve better profitability. Now, the last thing that there is to touch on is the forecast for next quarter. And as you could have probably guessed, the management is expecting the strong growth to continue. The gross consumer loans are expected to increase by a further $175 to $200 million. Net charge-offs are expected to be in line, and the total yield on consumer loans is expected to decrease slightly alongside the trend of lower average APRs. And that was the quarter. It was a pretty big one in terms of the numbers that were put up, which was probably why we saw the share price spike 13% the day after the press release was issued. But the key concerns haven't really been quelled, and I don't know that they even could have been. Now, don't get me wrong, this was a very good quarter. The growth was once again incredible, and the continuing lower average APRs is great to see. However, there are still two huge questions that are lingering. The first is, will there be additional future regulation? And second, if a serious recession were to happen, would Goeasy be able to make it through? Personally, I don't think that either of these two events are super probable, but either scenario is still very much a possibility. So while it is great that the company has continued to put up really good numbers and will probably do so in the future, in the grand scheme of things, that won't really matter if there's a devastating recession in say 2026 and net charge-offs spike to something like 30 or 40%. In a scenario like this, virtually all of the gains would be wiped out in an instant. And that's far from an impossibility with a company like Goeasy that borrows a lot of money and then lends it out to people who are at a higher likelihood of defaulting on loans under normal economic circumstances, let alone in a bad or terrible economy. So, until the company has achieved some greater geographic diversification and achieves a more defensive balance sheet that is less reliant on long-term debt, the company will not be a sure thing. And if the company ever does overcome those two hurdles, then chances are that it won't be discounted anywhere near as heavily as it is now. So I think that it's very important to realize that the current discount has a lot of risk baked into it. Noting that, I personally don't exactly dislike the current risk-reward scenario, because, like I said earlier, I don't think that additional regulations are very likely, which just leaves the risk of a major recession. But even still, I think that there are a fair amount of instances where a company like Goeasy can make it through a big one without getting completely crushed. That said, things did look a lot better before the blowout earnings shot the price up. Thankfully, I already managed to pick up a good amount of shares after the regulation announcement knocked the stock into the low $90 range. Plus, I bought a lot of my shares a few years back when the share price was in the process of dropping from $60 down to $20. Now that the stock price is back up, however, Goeasy has popped its way back into the largest position within my TFSA. So I'm not really looking to buy any more shares in my personal accounts unless the stock drops back down and there isn't anything that looks cheaper to buy. As for my $100 per month Canadian stock portfolio that I document the process of as part of a series here on my YouTube channel, I just began building my position in Goeasy post-regulation, and I might continue to purchase fractional shares here and there depending on what price I can get them at. But at the current levels, I might just be better off sticking to my other holdings that are slower growers with more certain futures. Regardless of what I choose to do in the monthly portfolio, I hope that you found this video helpful in gaining a better understanding of the company, its earnings, and how I'm looking at the stock. That said, please be aware that my opinions on the stock are just opinions, and it is possible that I am incorrect in my assumptions, so make sure to do your own research and come to your own conclusions before making any investment decisions. I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions, so this video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes to invest and share what I've learned with others. In doing so, I hope that I was able to provide you with something of value, and if I have, then please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.